welcome you to the deep dive. Today we are really focusing on something fascinating. It's this intersection of high-tech, finance, and, well, regulatory law. And it's an area that, until very recently, has just been a source of constant friction.
Yeah.
You know, in the whole digital asset space, we're talking about that fundamental uncertainty, what is a security in the U.S. and what isn't.
Yeah, that uncertainty has been a huge shadow over everything.
Exactly. But the news we're unpacking today,
Yeah.
it's actually not another lawsuit. It's not another crackdown. It's the opposite, really. A context shift that feels, I don't know, profoundly positive. And pretty rare these days.
Definitely rare.
The SEC, believe it or not, has issued a strong signal. They've clarified that a specific class of digital assets, these utility-focused ones called DePIN tokens, are, and this is the key part, fundamentally outside its core jurisdiction.
Right.
When you think about the mood music over the last few years, this is more than just good news. It feels like a structural pivot.
It absolutely is.
Yeah, massive for projects trying to build actual, decentralized infrastructure, real things.
That's absolutely right. And our mission today for you listening is to really give you the full picture here. We need to unpack what DePIN, that's decentralized physical infrastructure networks, what that actually means.
Okay.
We've got to understand, really get into the technical and the legal details, why this specific exemption matters so much. Why is it such a game changer, especially with all the legal turmoil around almost every other kind of token?
Good question.
And then finally, we'll explore what this clarity actually means, practically. For the developers building this stuff, for institutional investors looking at the space, and really for the long-term future of Web3 infrastructure itself.
Okay, let's unpack this then. Let's get into the specifics. So maybe to start, let's just lay the groundwork. What exactly are DePIN tokens? How are they functionally different from, the thousands of other tokens floating around out there?
Okay, so at their core, DePIN tokens are basically the lifeblood of these decentralized infrastructure networks. Think of them as the incentive engine. They power this shift away from centralized systems like, huge Amazon server farms or big telcos towards distributed peer-to-peer networks.
Right, run by individuals, it sounds like.
Exactly. And the key difference, the thing that regulators seem to have latched onto, is their utility focus. That's crucial. These networks aren't just like selling digital coins. They're crowdsourcing real-world physical capacity, bandwidth, storage, compute power. The tokens themselves are fundamentally designed to get people, individuals, to actively participate by contributing tangible, verifiable resources, things you can actually measure.
So, okay, let me see if I've got this. We're talking about rewarding people for taking a physical asset they already own. Maybe it's unused internet bandwidth or spare space on their hard drive, or even an idle graphics card.
Yeah, exactly, that kind of stuff.
And turning that into a service that someone else can buy on this decentralized network.
Yeah.
The token is the payment, the reward mechanism.
Precisely. They reward real-world contributions. Simple as that. So, if you run a node for the network, you earn tokens. If you offer up storage space, you get paid in tokens. Provide compute power, you get tokens.
Okay.
The whole token economy is built around generating physical output. Real utility comes first. This makes them more like consumption assets, things you need to use the network, rather than just purely speculative financial instruments you hold, hoping the price goes up.
That makes sense. Can you walk us through some of the main examples, the ones leading the charge here, according to the sources?
Sure. We basically see three main categories kind of defining the space right now. First, you've got the wireless sector. The big name there is Helium, HNT. They're focused on decentralized wireless hotspots, building out like a peer-to-peer 5G network.
Interesting.
Second, there's the storage sector. Filecoin, FIL, is the dominant player there. They're creating this global decentralized marketplace for data storage.
Right, I've heard of Filecoin.
And third, you have the compute sector. Render, RNDR, is leading that one. They pool together unused GPU power from around the world for rendering tasks, complex computations.
GPUs, yeah, very relevant now with AI.
Extremely relevant. And what ties all these projects together, really, is they're all trying to build infrastructure that can actually compete with the Web 2 giants, the Amazons and Googles. But they're doing it using a decentralized open source model powered by these tokens.
And that brings us straight back to the breaking news. Because for years, like we said, the U.S. regulatory scene has just been this huge gray area for crypto. So the fact that the SEC proactively looked at these specific utility models and basically said, yeah, these seem fundamentally outside our jurisdiction, that's a massive relief, frankly.
It really is. It's not just a temporary break. It feels like a structural shift. And the immediate effect, a huge drop in regulatory uncertainty. To really grasp how big a deal this is, you have to understand that regulatory risk is one of the biggest costs for any large-scale project, especially if you're trying to get enterprise clients or raise serious institutional money.
Right, the lawyers aren't cheap, and the risk is hard to quantify.
Exactly. Before this, the ghost of an SEC enforcement action was always hanging over these projects. Imagine you're trying to build out infrastructure over multiple years, deploying thousands of physical devices. You were always operating with this legal sword hanging over your head.
So what's the biggest practical change then? Does this mean they can, like, reallocate their budgets now? Less for lawyers, more for building.
It absolutely does. This
Yeah.
clarity basically greases the wheels. It removes a ton of compliance friction. Think about it. If you're the CEO of, say, Filecoin, before this, a huge chunk of your legal and compliance budget was probably tied up in just trying to prove you weren't selling an illegal security in the U.S.
Yeah, constantly defensive.
That massive overhead, which definitely scared off potential enterprise deals and institutional investors, is now significantly lower. This clarity basically unlocks development and adoption that was kind of frozen before.
How so?
Well, imagine a big telecom company wanted to maybe integrate a decentralized solution like Helium's network. Their legal team would have likely thrown up huge roadblocks because of the legal ambiguity around the HNT token itself.
Makes sense. Too risky for a big corp.
Exactly. Now, those objections are much, much weaker. This fundamentally shifts these DePIN projects out of the high regulatory risk category and puts them squarely into the infrastructure innovation bucket. And that's where the serious institutional money and the big enterprise contracts tend to live.
That reframing is huge. From risky crypto asset to infrastructure innovation, it gives them permission to play in a different league.
Permission to play in the big leagues, absolutely.
Okay, let's dig into the legal side a bit more. What actually allowed this distinction? In the U.S., everything seems to come back to the Howey test when deciding if something's a security.
That's right. It's this infamous four-part test from a Supreme Court case way back in 1946. Still the standard today for figuring out if something counts as an investment contract.
Right, the 4 prongs.
Exactly. For something to be an investment contract and therefore a security under SEC rules, you need 1, an investment of money, 2, a common enterprise, 3, with an expectation of profit.
Okay, most crypto ticks those boxes pretty easily.
Right. But the fourth one is the kicker, derived solely from the efforts of others.
Solely. That word seems important. So how did DePIN manage to, navigate around the ambiguity that catches almost every other token? Which part of that test did they challenge?
Well, while most tokens clearly meet those first 3 parts people put money in, hoping the price goes up because the core team builds something cool, DePIN projects successfully challenged that 4th prong. Or, maybe more accurately, they significantly weakened the solely part of it.
How so?
With a typical speculative token, your hope for profit rests almost entirely on what the core development team does, right? Their marketing, their roadmap execution. You just hold the token and wait.
Yeah, pretty passive.
But with DePIN, what this SEC signal suggests is a recognition that the token's value, or at least the rewards you earn, depend heavily on the active effort and tangible contribution of the network participants themselves, the node operators, the storage providers.
Okay, let's make that really concrete. So if I buy, say, some random new DeFi token, I'm basically betting on the founders to make it successful, get it listed somewhere.
Right, you're relying on their efforts.
But if I get involved with Helium, I don't just buy HNT. I actually need to buy a physical hotspot device, set it up, make sure it's online, providing real wireless coverage. Then I earn more tokens.
Precisely. You're not just a passive investor in that scenario, you're an active service provider. The token isn't just an investment, it's necessary for the function of that decentralized marketplace. It's how you get paid for the physical service you're providing.
And if I turn my hotspot off,
Then you stop earning rewards. Simple as that. The profit, or the reward, is directly tied to your effort, your contribution, not solely the efforts of the Helium developers. That functional necessity, that measurable utility you provide, that seems to be the critical legal difference here.
okay, I see. And if the SEC is acknowledging that fundamental legal distinction, wow, the risk profile for big companies and institutions just drops dramatically.
It really does. It changes everything about how these tokens can be listed, held, and invested in.
How so?
Well, it basically creates a much clearer pathway for formal institutional investment, the kind that's been sitting on the sidelines, nervous about the legal gray areas. Big institutional money, pension funds, endowments, they have super strict compliance rules. They just can't touch assets that are legally ambiguous.
Right. Too much career risk for the fund managers.
Exactly. So this clarity could pave the way for proper listings on regulated exchanges, maybe even ETFs down the line, who knows. And crucially, it simplifies custody. Big custodians, the companies that actually hold assets for these large institutions, they need legal certainty. This ruling gives it to them, specifically for these DePIN assets.
The institutional angle is huge. It potentially shifts the whole sector from being mostly retail-driven speculation towards serious long-term capital allocation. And speaking of capital and support, before we dive even deeper into how this SEC ruling could really supercharge the DePIN sector, maybe this is a good moment for a quick word for you, the listener. Look, and we're trying to build our own kind of decentralized network right here, a community focused on getting you deep, unbiased insights like this.
Yeah, digging into the complexities.
Right. So if you're finding this breakdown valuable, if you appreciate us going beyond just the headlines to tackle these tricky legal and tech issues, please take just a second to engage with us. You know, the drill subscribing, maybe leaving a comment, hitting that like button, it genuinely helps support the channel. It boosts our visibility in the algorithms, and honestly, it lets us keep putting in the time to create this kind of quality, in-depth content for you every day.
That community support really does make a difference for creators trying to provide signal in the noise.
Absolutely. We really rely on it to keep the deep dive going strong.
And if we connect that idea of support and stability back to the SEC news, this regulatory certainty, it's arguably the single most valuable thing that could have happened for this sector, maybe in years. It's worth more than any short-term pump or speculative hype, easily.
Why more valuable than hype?
Because hype fades, right. But certainty allows for actual sustainable infrastructure building. We're talking multi-year projects, real physical deployments. For big global companies looking at maybe using decentralized services, this is like foundational law getting established for tokenized infrastructure. It lets them trust the underlying economic model won't just disappear because of a regulator. It gives them confidence in the longevity.
Confidence and longevity. Okay, that makes perfect sense for infrastructure.
Yeah.
So here's where it gets really interesting, I think. Because this SEC signal isn't just theoretical. It feels like a validation of stuff that's already happening. Real-world traction. Let's look at the actual evidence. The specific examples that show these projects are creating verifiable physical value. What do they likely show the regulators?
Well, you have to start with Helium, HNT. Yes, they've had some bumps in the road, some controversies early on, but their core mission, building a decentralized wireless network, is undeniably focused on physical infrastructure.
Right, the hotspots people deploy.
Exactly. The network is literally made of individuals deploying physical devices to extend wireless coverage. So what's the proof of real utility? Well, look at their recent big infrastructure move migrating their core logic to the Solana blockchain for better speed and scalability. That's a serious technical lift.
Okay, technical upgrades are good, but what about actual use?
That's the critical part. Their existing partnerships with actual telecom providers. That's hard evidence.
Can you elaborate on those? Are we talking about pilot programs or real integration?
No, they've moved beyond just proof of concepts. Helium has really focused on deploying specialized 5G small cells, and the utility is shown through major partnerships, like the one with DSH Network here in the US. They're helping DSH augment its 5G coverage.
So helium hotspots are actually carrying real 5G traffic for a major carrier.
In certain deployments, yes. It's not just a theory. It's a tangible, real-world service being integrated into existing cellular networks, often used to fill coverage gaps, especially for Internet of Things, IoT devices that need low-power, wide-area coverage. That level of integration with a legacy player, that's very difficult for a regulator to just dismiss as pure speculation.
Wow. Okay, that integration with established players is definitely key for legitimacy. They're actually augmenting the real world, not just building some separate crypto thing.
Precisely. That's a powerful argument. Okay, next up, Filecoin, FIL, the decentralized storage network. We all kind of get the idea of decentralized storage, right? Using spare hard drive space globally. But the real game changer here is who is using it, the clients they're attracting.
Oh, we're talking about
Potentially massive storage deals with very established, sometimes very sensitive Web 2 companies, and even aerospace firms.
Aerospace. Okay, now you have my attention. This is where that Lockheed Martin anecdote comes in, right?
Yeah.
That sounds almost unbelievable. A major defense contractor using decentralized storage.
The sources confirm it. There's a partnership there. Often it's for things like archival data, stuff that doesn't need to be accessed instantly, but needs long-term secure storage.
But why Filecoin? Why not just use Amazon S3 or something similar?
Good question. Filecoin offers certain advantages for specific use cases. Things like cryptographic proof of storage, meaning you can mathematically verify your data is still there and hasn't been tampered with, and incredible redundancy. Lockheed Martin, for example, is reportedly using it to store space data from missions that needs to be kept securely, verifiably, for potentially decades.
Space data.
Wow. Yeah. The data gets broken up, encrypted, and distributed across potentially hundreds of independent storage providers all over the world. This isn't Lockheed making a speculative bet on FIL token price. This is a serious business relationship built on verifiable security features and utility. That kind of use case provides immense comfort from a regulatory perspective.
Absolutely. That level of serious enterprise adoption makes the utility argument incredibly strong. Okay, let's shift to compute power. Render, RNDR. Coordinating distributed GPU power for rendering.
Render's timing has been, well, pretty perfect. They tap into all this unused GPU capacity sitting idle in computers around the globe and offer it up as an on-demand cloud service.
And GPUs are suddenly incredibly valuable.
Stratospherically valuable. There's a global GPU shortage driven by the absolute explosion in demand for AI model training, complex machine learning, high-fidelity graphics for gaming, and the metaverse. Render is essentially supplying a critical, scarce resource GPU time, and the RNDR token. It's literally used, it's consumed to pay for that rendering time on the network.
So it's not just held, it's spent to access the service.
Exactly. Its utility is directly tied to this real-world technological demand and scarcity. It functions as a consumption token within that ecosystem.
That distinction seems crucial again. The token has to be used, maybe burned or staked or spent, to actually pay for the physical service. It can't just be about hoping the price goes up.
Absolutely. The tokenomics are designed to enforce that utility. It's baked into the system. And we should also mention the decentralized cloud competitors like Flux and Akash. They are sitting in a very good position now, too.
How do they benefit specifically? They're going up against giants like Amazon Web Services, Google Cloud.
Well, Flux and Akash are competing head-on in that decentralized cloud compute space, offering virtual servers, storage, hosting potentially at lower costs, and with more resistance to censorship or single points of failure than the big guys.
Okay, that's the pitch.
But to really compete, to attract major enterprise clients, which you need to do to challenge AWS or Azure, you absolutely require regulatory stability. No big company will switch their core infrastructure to something legally risky. This SEC clarity gives them that crucial regulatory tailwind. They can now go into meetings and credibly pitch themselves as offering a robust, legally sound alternative infrastructure. It helps them sign those larger multi-year deals that need stable legal ground.
So when we talk about proving DePIN's utility, the data points regulators likely looked at weren't just market cap or trading volume, right? What are the key metrics that actually show this stuff is real?
Yeah, forget just price charts. The empirical evidence is everything for regulators. They want to see the physical infrastructure data. So we need to look at things like the number of active nodes deployed globally, how many physical devices are actually participating. That shows network reach and resilience.
Okay, node count. What else?
Actual usage. Total bandwidth being consumed on the network, measured in terabytes or petabytes. Total storage being utilized, measured in petabytes or even exabytes for someone like Filecoin. These are the heart metrics that show genuine, sustained, real-world activity and traction, not just hype.
Right.
And importantly, the growth in the overall DePIN market cap, if you look at HNT, RNDR, FIL, Akash together, you can see it's generally correlated with the growth and utilization of their actual physical network footprint. That's what differentiates them from purely speculative tokens or governance tokens with no direct physical link.
And it's likely those measurable physical metrics, the nodes, the terabytes, the petabytes, that ultimately convince the SEC that yeah, this category really is fundamentally different.
That's got to be the key takeaway on the regulatory side. They saw a network of actual physical assets providing a real service, not just a pool of money-chasing yield or price appreciation.
Okay, let's pivot now to the market outlook. For you listening in, maybe you're an investor, maybe just trying to understand the landscape. What does this clarity actually mean for how you might look at digital assets now? This feels like a catalyst, but how might it play out?
Well, the first big consequence, I think, is a potential market re-rating for these specific tokens. By explicitly reducing that huge regulatory risk premium that was weighing them down, DePIN tokens are suddenly positioned as, well, arguably safer, more stable, long-term infrastructure investment
Safer compared to what?
compared to other crypto assets that are still stuck in that legal gray zone. Many DeFi protocols, purely speculative coins, things where the Howey test questions are still very much alive. This reduction in perceived risk means their baseline valuation could fundamentally shift upwards.
Interesting. We've definitely seen specific narratives catch fire in crypto AI tokens earlier this year, RWA, or real-world assets. Could DePIN become the next big narrative to attract serious capital?
I think there's a very strong case to be made that it could. DePIN sits right at this powerful intersection of two narratives that have already proven successful. One, physical infrastructure, tangible assets, that's the RWA connection. Two, computational utility, providing essential digital services, that's the AI connection, especially for compute providers like Render.
So it bridges those two hot themes.
Exactly. We saw huge capital flows driven by AI and RWA already. DePIN is kind of uniquely positioned to potentially capture the next wave, especially from institutional investors who see both high utility and, now, lower regulatory risk. It ticks both boxes.
Makes sense. What about the short-term market reaction? Trading, immediate price movements?
Yeah, the immediate response is often fueled by traders anticipating what the bigger money will do later. So you'll likely see traders trying to front-run that expected institutional interest, get in before the big funds potentially start allocating.
So volume spikes.
Definitely expect significant trading volume spikes right after news like this breaks, showing liquidity shifting. But maybe more importantly for analysis is watching the trading volumes persistently over time. Comparing pre-announcement levels to post-announcement levels, that can be a marker of whether real institutional, large-scale investor interest is actually entering and staying looking for these now more compliant assets. The smart money often moves once the legal danger clears.
Okay, let's zoom out a bit. The Web3 ecosystem as a whole. We always hear talk about Web3 needing robust infrastructure to succeed. Does this ruling finally help prove that tokenized infrastructure is the way forward, the essential backbone?
I think it absolutely does. This outcome significantly strengthens the argument for tokenized infrastructure being that crucial foundation. It helps move the perception of Web3 beyond just niche financial games or digital collectibles towards building the actual robust, maybe more censorship-resistant rails for the future economy.
It validates the core idea.
It validates the core idea that decentralization's true power might lie in building resilient infrastructure. And another big implication, this clarity could open the floodgates for new DePIN projects.
Oh, yeah. In what areas?
Well, if the legal model is now seen as more viable, more accepted, we could see a real acceleration in other critical sectors, areas that are ripe for decentralized disruption but were maybe held back by regulatory fear. Think about things like decentralized energy grids, coordinating local power generation and storage, or maybe supply chain and transportation logistics networks using tokens. Advanced IoT device networks, highly specialized cloud computing niches.
Wow, the potential is huge once that legal uncertainty is lifted. It sounds like this ruling almost creates a clear dividing line in the crypto world now.
I think it does create a really crucial separation, or at least helps clarify it. This ruling helps segment the market more accurately in the eyes of regulators, institutions, and even sophisticated retail investors. DePIN is now more clearly recognized as infrastructure tokens, assets tied directly to network function, linked to physical services.
Okay, so infrastructure tokens on one side.
Right, and that's fundamentally distinct from, say, DeFi governance tokens, which mostly give voting rights, or purely financial speculative tokens with no underlying utility, or, meme coins. This separation allows everyone, capital allocators, investors, regulators, to define and manage risk much more effectively across these different segments of the broader crypto market.
That makes a lot of sense for market maturity.
It does. And what's really fascinating to watch now is this question. Will DePIN tokens, because they have this regulatory green light and they provide critical, verifiable physical infrastructure, will they become the next major crypto narrative? Following on from the big waves we saw with AI and RWAs, that combination of legal safety and real-world utility arguably makes them one of the most compelling sectors to watch heading into the next market cycle.
Yeah, I think the evidence points that way. Regulatory certainty plus real-world utility, those seem to be the magic ingredients for sustainable growth, and DePIN seems to have hit that sweet spot now. #outro. So, okay, let's wrap this up. The core takeaway from our deep dive today for you, this isn't just some minor industry news. It feels like a really significant structural shift. Regulatory clarity from the SEC on DePIN tokens basically turns deep uncertainty into a huge opportunity. It's an official nod to the utility-first, infrastructure-focused nature of these specific decentralized networks.
And for you, the learner, really understanding the distinction between being a passive financial investor versus an active service provider within a network, that's going to be key to navigating what comes next in crypto development. It clearly signals where regulatory stability is emerging and where serious capital-intensive infrastructure building is likely to accelerate. So look for the utility, look for those real-world physical metrics we talked about, node counts, data usage, and definitely track the enterprise adoption. That's the roadmap going forward in this space.
Yeah, we've seen the proof points today, from Helium integrating with major telcos like DCH to Filecoin landing high-security contracts with giants like Lockheed Martin for storing space data. The utility is becoming undeniable.
Yeah.
The regulatory risk, while never zero, has been profoundly lowered for this category. It really feels like the race to build that tokenized, decentralized backbone for Web3 is now properly underway, with fewer hurdles.
Which leaves us with maybe one final provocative thought for you to mull over, building on everything we've discussed about utility and compliance. Could it be that DePIN tokens, precisely because they solve tangible, real-world, physical infrastructure problems, and because they've now navigated towards regulatory compliance, could they actually turn out to be a more important, more foundational layer of the future digital economy than even the clever financial innovations we've seen in DeFi over the long run?
Infrastructure versus finance. That's a big question to ponder.